Good evening, everyone. I am Jim McCarthy with Avid Realty. And tonight, we've gone a little different direction than our normal webinars. We're going to do what to do with $50,000, invest versus savings. And really, the idea comparatively, where's your money going to grow the most? And I think we're going to prove our point, obviously, today with the idea of investing in real estate. The other interesting thing I think you'll see is you get a little look behind the curtain. I mean, these are conversations we're having with our investors routinely. So I think it's going to be a really good hour. We're going to cover a lot of information. And as always, we're going to leave time for questions at the end. So with that, I'd like to introduce our founder and CEO, Craig Berger.
Thanks, Jim. Appreciate it. Thanks to everyone who's joined and for all of you that will watch the recorded version of this later. Really, we're going to go over just some very basic information about real estate versus the stock market versus savings. I did spend 12 years on Wall Street as a sell-side equities analyst, so had the good fortune of living in the equities world for a long time. I think I have some perspective on both the stock market and real estate. And then we're going to really save a bunch of time, maybe in the after the first 20 minutes or so, to talk about the current environment, to talk about what investors are telling us, to talk about where we see interest rates going, pricing going for real estate deals, and just sort of touch on the current environment and how we see the world. So thank you for joining, and Jim will be asking some questions. I might ask him some questions back, and we'll go from there.
Oh, let's get right into it. Financial plan, like when we talk about, someone asks you about how do I plan financially for the long term and setting overall goals, what do you tell them? And then obviously, how do you lead that into the discussion of the benefits of real estate?
Fantastic. Well, look, everybody needs a plan. A lot of people that aren't in the financial world might have a financial advisor. Um, Maybe you have a 401k or an IRA, but saving for the future is imperative because I don't think Social Security is going to be fully funded. You need to provide for your own future above and beyond and apart from Social Security. And that means saving and compounding your savings and investments over decades. But certainly a strong wealth manager or financial advisor is important. And also you need to understand, what are your shorter term goals? What are your longer term goals? Do you need to pay for your college, your kids' college education? When might that happen? Sort of what are your priorities between growth versus income stream versus low risk capital preservation? And sort of what are your priorities or allocations between investing in the stock market versus bonds versus real estate versus Bitcoin and crypto versus venture capital or other alternative classes. So comprehensive plan, a plan that's reviewed once a year or more with your advisor is critical. Everybody should do that.
Excellent. So obviously what you tell people being in the real estate business is invest in real estate. So why don't we get in a little bit of your take on the benefits of real estate?
Sure. So look, I don't think people should put 100% of their money in real estate, although I have. Um, but real estate is a part of an overall comprehensive investment plan, right? I do think there's a place for stocks and bonds and other stuff. I happen to think real estate is the best asset class out there for a number of reasons. But in terms of some of the benefits, right? First, you get ongoing cash flow, 5 to 8% a year, I'd say is typical in multifamily. Maybe it's 4 to 5% in multifamily in year one, and 7, 8, 9, 10% in multifamily by year five. But that compares to historical dividend yields on the stock market of something in the 2% range, which is more typical for equities. So we like 5 to 8% annual cash flow. Right. Secondly, real estate typically tends to appreciate over time, certainly over the long term. And this is made all the more powerful through the use of debt, right? If you're um, buying a piece of property that has an unlevered yield of 5% and you're borrowing debt at 5%, and there's some appreciation there, then that appreciation is amplified by the fact that you're only putting 25, 30, 35% of your money into a property as equity, right? You're keeping all of the upside for the most part, and cash flow is paying your debt, right? Third, very importantly, tax benefits, right? Real estate has phenomenal tax benefits. It's because Congress makes the laws. Historically, Congress has wanted to incentivize real estate investing, and they have, right? The most important thing is that in real estate, you get depreciation expense, which is not a real expense, it's a phantom expense. It shields your income from taxation. You get current year distributions every year. They're usually totally tax-free due to this phantom depreciation expense. And then down the road, when you finally sell the property years later, you pay capital gains tax rate. So capital gains tax rate is 20% versus the highest federal income tax rate, marginal highest rate of 37%. Um, in places like California, they charge 13% on on your capital gain or income. The state's highest rate in the state. So between federal and state in California, you're paying 50% income tax. If you are in the real estate game in Texas or Florida, you're paying 20% tax. Well, that is a monster difference between a 50% all-in rate on income in California versus a 20% all-in rate on capital gains in Texas, Florida, Nevada, Tennessee, and a couple other no-income tax states. I think Alaska's on the list, maybe South Dakota. But you cannot get away from the tax benefits of shielding current year income, getting cash today that's tax-free, and paying capital gains later. A couple other things, right? Real estate allows for diversification from stock market volatility. Changes in real estate value tend to happen more slowly. So sort of less, not no correlation with the rest of the world, but certainly less correlation. And then fifth, real estate does act as a hedge against inflation, right? The value of real estate is typically based on the rents that are collected. Those rents rise over time, and especially with inflation. Real estate values are certainly impacted by construction costs and replacement costs. We tend to think of construction costs as the rudder that helps guide the floor value of real estate. And so as inflation grows, so too does the replacement cost of your real estate and the underlying value of your investments.
And again, we always say we're very transparent. So objectively, what are some of the drawbacks to real estate?
Right. Well, the biggest drawback is once you invest, you're in the deal. I mean, your investment is not liquid. It's highly illiquid, right? You invest with a sponsor like Avid Realty Partners, or you invest in maybe a crowdfunding site like Realty Mogul or CrowdStreet. Once you invest in that deal, you're riding the ride for the duration, and you don't get your money back until at some point you sell, right? Maybe you can sell faster than you expect in 2 or 3 years, and you caught a market wave and you found a great exit, but maybe you missed your exit and you're writing that deal for 7, 8, 9 years in some cases. So that's the biggest drawback, right? Obviously, there's other drawbacks, like if you're not going to invest with a sponsor or through a fund or something else, passive investing is great, but it does force you to rely and trust sponsors and other people. If you're actively investing, right, you have your own rental properties, you buy a small strip center or whatever floats your boat among the various real estate asset classes. it does require a lot of work, a lot of effort, a lot of time, a lot of tenants, toilets, and trash. So there's obviously benefits to active investing. You get to control your own destiny entirely. But the workload is substantial, and there's obviously risk, right? If you have a desk job, you might not want to spend a lot of time and attention collecting rent and dealing with tenants. So those are a couple, a couple of negatives. I guess one more I'd throw out there is that real estate moves very slowly, right? Your returns happen slowly. They build momentum. Your mortgage is fixed. Your rents slowly rise over time, and that spread widens. So really, Father Time does a lot of the heavy lifting on your returns in real estate. But it takes time. There is no get rich quick, right? There's no, oh, I bought Bitcoin at 20 and now it's 60,000. It just is very rare in real estate. It's get rich, slow, safe, securely, predictably, but not quick. Um, so, lack of liquidity being the biggest drawback to real estate.
It's great. So I think, we joke, we're talking about real estate versus savings, but I think the real discussion is, should I invest in the stock market? And you originally said, we talked about diversify, but stock market, what are some of the positive negatives that you see? And then obviously we could talk about it compared to real estate. But again, maybe in one answer, you could say the positives and negatives of investing in the stock market.
Sure. So, I lived in the stock market for 12 years. Had the opportunity to, live and breathe the markets daily, ride the economic cycles, underwrite companies, right, study institutional mindset and risk management. It was great. Um, Ultimately I wanted to roll up my sleeves and be entrepreneurial, but there's a lot of great things about the stock market. The main benefit is you have constant liquidity. You can always buy and sell your position immediately, get your cash, right? That same liquidity leads to potentially massive changes in the value of any particular stock overnight, right? It's not unheard of for stocks to drop 20, 30, 40% on bad news event, bad news earnings. And so it does move quick and is highly volatile. But another benefit is, the SEC regulates all of these companies, and there's a lot of information and disclosures and 10Ks, annual reports, and 10Q quarterly reports, and you can, dig up and do just a ton of research and information on any potential company or stock, right? Obviously, investors in stocks have access to the greatest companies in the world. Um, Apple, Amazon, right? Tesla, just to name a few. Um, and I sort of touched on this, but you can realize large gains or losses relatively quickly. In terms of some of the negatives to stock market investing, just tactically, right? There's a whole world of hedge fund folks and day traders that are babysitting their investments, their stocks 24/7. And the thought of an amateur investing into a stock and knowing more than the hedge fund guy who's followed that stock for decades and who's babysitting that stock as his job is, you know, it'd be kind of arrogant to think that a novice spending 5, 10, 15 minutes a day can out invest a professional who's doing it full time. Another significant drawback is the double taxation of dividends. Corporations pay taxes on their income, theoretically, and then when you receive their dividends, you pay taxes again, and that dividend income is treated as ordinary income. It's not taxed as a capital gain for tax purposes, right? One other just thing to note is that fee stacking happens more often in stock market investing than in real estate investing. Although fee stacking can happen certainly in real estate investing too, but a lot of times you pay your RIA wealth manager 1% a year to manage your portfolio, right? And then they go out and invest in hedge funds or mutual funds that are charging fees, or other fee-based investment instruments. So there can be a lot of fee stacking. Sometime in the real estate world, there's fee stacking too. Hopefully, if you're paying multiple layers of fees, you're getting the oversight um, and adult supervision to make sure that your investments really perform.
Excellent. I think it's in our title, so we should at least talk about it. Give me your thoughts on just, especially maybe at a time like now, just putting $50,000 in a savings account and walking away. What are your thoughts on that?
Well, you can theoretically get your money out at any time. Obviously, if anything under 250,000 is FDIC insured, so you're never going to lose your $50,000. But the reality is inflation is somewhat meaningful today, and bank accounts are generally paying almost no interest. If you buy a 6-month CD, you get, a couple points of interest right now. Then you wouldn't have access to your money for 6 months, but you would get some interest. But really, earning nothing in interest is the equivalent of losing money in real dollars because inflation happens. So $100 today is $105 tomorrow, is $110 next year. So if you still just have $100 in the bank, you're losing money, particularly over the last 3 years when I think real live inflation has been on the order of 50 to 75%, right? I know the government likes to say, well, inflation was 10%, then it was 8%, now it's, 5%. I happen to think we've experienced 50 to 75% inflation over the last 3 years. Anybody who's gone out to buy food, cars, um, entertainment, right? I think would probably agree. We can get into the reasons of why all of that inflation happened, and hint, it's not because of COVID, it's because of the Federal Reserve. Um, but really, you need to invest your money just to stay in the same place, right? If you don't invest your money's just shrinking because of inflation.
Excellent. So, multifamily, just point blank, why do you love multifamily?
I love multifamily, and the reasons are 45% of the country rents their homes, and multifamily is essential, right? People have to live somewhere. Demand doesn't change much based on the economy. It might change a tiny little bit here and there. Um, but you either own a home or you rent a home. And a lot of the country rents for various reasons. Some people are renters by necessity, meaning they don't have the money to buy a home. Some people are renters by choice because they don't want the responsibility of owning a home and all of the repair and maintenance and added, cash flow expense, or they don't want to be tied down to one location. So, not everybody can or wants to own a home, which is why multifamily and rentals in general are such a great real estate asset class. A couple other reasons why we like multifamily: rents hardly ever decrease. For all of you folks that have rented out there, how often, when your lease comes up for renewal, does your landlord say your lease is expiring and we're lowering your rent this year? Hardly ever happens. In Manhattan during the height of COVID and in late 2020 or early 2021, it happened for like 5 minutes, right? And then that went away. Um, right? Long-term inflation and rising construction costs mean that apartment values typically rise over time. Right? We talked about how tax efficient real estate and multifamily investing is, both for current cash flow that basically goes untaxed and for long-term appreciation that's taxed at capital gains. And because, in multifamily particularly, we have Fannie Mae and Freddie Mac, these pseudo private, pseudo government owned agencies provide debt finance at incredibly attractive rates. I know everybody's complaining about interest rates right now. Obviously, they have gone up a lot, but we're buying a deal right now, and we're going to be borrowing at 5% interest on that deal, maybe below 5%. Yeah, we're taking advantage of a very small rate buy down that the agencies are offering. But that stability to be able to borrow from pseudo government backed agencies, Fannie Mae and Freddie Mac, at still low rates, that availability of financing, the ability to refinance, suck your money out and continue to own the asset is phenomenal.
So not all deals are created equal. What factors do you look at when determining whether you should buy it or not?
Wow, how much time do we have? Assessing real estate deals is not easy. Um, but some of the things we look at are obviously where is the deal located, both what market, what sub-market within that market, right? Who is my customer or resident? How much income and earnings power does that resident and customer have? Um, right? Am I, you know, well, age of the asset's really important. Am I buying a 2022 built deal that requires no capital? Or am I buying a 1972 built deal that will have a lot of capital requirements forever and ever because that's what 50-year-old properties have. Um, a couple other things. What are the property's amenities, right? What's nearby to the property? How attractive is it for renters? Is there transit, um, within a 2-minute walk, or is it in the middle of nowhere? What restaurants and retailers are right nearby, right? Is it live, work, play? Um, um, Ultimately, a lot of that can be boiled down to how much is rent and how much do I have to pay to purchase the asset per door? How much capital does that asset need? And based on that ratio, we have a pretty good idea just from being in the market, looking at thousands and thousands of deals, whether a deal is a good value. So, right, ultimately, we need to buy um, assets that are attractively priced so that we can generate and deliver returns to our investors. And so I'd much rather buy 1,500 of rent for 110 times earnings than buy 1,500 of rent for 200 times rent. So we do look at the price per rent ratio, and that's sort of a big factor of how we quickly assess the value of the deal. But we also look at potential rent.
So, how about right now? You talked about all the factors, and we're hearing obviously, and we've talked about it week after week, people on the sideline. Um, is now a good time to gain exposure to real estate? Especially with homeowner affordability.
Well, I think it's always a good time to invest money if you have money because you need to make that money grow. But I do think now is a particularly attractive time to deploy capital. Um, I think real estate's going to do well over the next 5 years. I think the stock market could do reasonably well over the next 2, 3 years as well. But really, it's in real estate, it's a much less efficient market than in the stock market, right? Price discovery happens more slowly, it's less efficient. You don't have um, hundreds of orders coming in every minute for a particular asset, both buy and sell to make a market the way you do in stocks. So, that pricing mechanism is a lot less efficient in real estate than it is in the stock market. Right now, I feel like, and you can chime in on this, Jim, but I feel like 75% of investors are not putting money to work right now in real estate. They're on the sidelines, pencils down, on the beach, however you want to put it, not trying to catch a falling knife and a couple other cliches. Um, and so that lack of competition, that lack of buyer pool means that we have the opportunity to buy assets right now at 20 to 30, 35% off in some cases versus where the asset was trading a year, 18 months ago, late 21, early 22. Maybe those peak prices, those bubble prices had some Fed driven irrational exuberance in them. But now we're buying at a deep discount below replacement costs, even for assets that are just a couple years old. And we think that's a stellar opportunity. So while everyone else is pencils down, um, we're making lemonade.
I guess
Now,
I
I
would
do
add,
think
go
that,
ahead.
go ahead. No,
The
you
other
go
thing I
ahead.
was going to say is we do hear that a lot. We're just on the sideline. But to your nice point, we haven't even told you what the deal is yet. And so this idea that, at least our investors would want to know that we're listening and we're out there. And to your point, we're working. We're not on the beach. We're not on the golf course. We're working because we're finding deals. And so this idea you say no before you hear what we've said, it's an interesting way to conduct business. And I'm not sure your investors recognize that you may be saying no to big gains down the road.
One of the folks that I've reached out to two or three times over the last 6 weeks texted me back this afternoon and said, we're pencils down on multifamily. And I'm like, okay, but like at any price, like what if you get the deal of a century brought to you in an amazing location, in an amazing market, at $100 per rentable foot, you're still pencils down. I mean, I'm always open-minded and willing to listen, but look, that's how it is. And part of that is I get it. People don't want to take career risk. Like if they buy during a risky time and that investment goes south or goes sideways, they're going to have career damage. If they wait and just buy when everybody else is buying, it's safe again,
Mhm.
right? But I'm an entrepreneur, so I have to generate good returns, and that means acting when others might view it as a risky move for their career. I look, I get it. If you've earned your way into an amazing institutional seat to deploy capital, you don't want to mess that up. Um, but I also, don't necessarily agree, and I'd be willing to look at any deal at any time.
So that's a little bit on
Uh,
our philosophy. So as you're advising someone, what are some of the things you would say about looking for the right sponsor? In terms of buying a deal. Obviously, we talk about investing. The best way to invest is not to pick up a shovel and start, getting into real estate yourself, but rather put your money with a firm that then goes out and buys and your money grows with them. What are some of the keys you would look at or some of the keys you'd point out to them?
so finding a great sponsor, there's a lot of sponsors out there. I don't think it's easy to tell who's great or who's not great. I think it's hard. Um, but I think the cornerstone of what we do is radical integrity. We're honest. We treat people well. We put other people first. Some of those factors would be important to me when I'm looking to invest my money with someone else that's not my own projects. Obviously, what's their experience and track record? Have they done this before? How many times? How have their results been? How long have they been in the game? What other life or investing experience might they have outside of real estate or multifamily? Um, what's their fee structure? How much do they charge in fees? How does that work? Do they have skin in the game alongside you? Are they putting their own money at risk on a net of fees after fees basis? Right? How much out of pocket is the sponsorship group putting out net of their upfront acquisition fee or any other closing fees? Those would be some of the things that I'd look at. Is there any historical litigation, judgments, foreclosures, defaults? Are these people nice to you when you talk to them on the phone? Those are some of the things that I think might be important to me. I'm not 100% nice on the phone either. I certainly have my moments, but I think generally, um, I'm nice to people. I want to work with people that are kind, that have integrity, that make smart decisions. You can be kind and make smart decisions. They're not mutually exclusive. You don't totally have to be a shark looking to rip off everyone in your path to be a shrewd and smart business person. So that's a little bit on my philosophy and maybe what I'd look for um, in a deal sponsor.
Um, so let's get a little
Did I
bit more.
miss anything?
Yeah, I think you missed the one. What's your philosophy on flying?
What's my philosophy on flying? That's a good question. I fly coach, okay, because I don't want to take such crazy huge fees, which comes out of my investors' pockets, that I'm flying private. Maybe someday I'll have had 100 exits, and I can fly, Comfort Plus. But look, we're conservative with how we spend money. We're conservative with how we charge fees, and I like that. I like being um, cautious about how I charge other people or how I spend other people's money. So right now I'm coach and I'm fine unless I get a free upgrade,
Free drink coupon. Let's get a little bit
free drink
into the
coupon.
market, the current market conditions. Um, you hear a lot of pundits talking about the economic malaise. And so maybe that's what's scaring some of the folks we're calling, saying we're sitting on the sideline. What's your take on that?
There is economic malaise, right? Everybody predicted a recession this year, including myself, at least a modest to moderate recession. When everybody predicts the same thing, you don't get it. You get something else. And I think that's just reality, right? When everybody says, oh, Apple's going to 200 and Apple does something else. It's just how the market moves. The market moves to create maximum pain between expectations and reality. Um, we are in economic malaise. I'd call this a soft landing. Certainly, interest rates have gone up a lot. People are hurting from inflation, from that 50 to 75% inflation over the last 3 years, brought upon by our wonderful Federal Reserve. Um, just so you know, the Federal Reserve grew M2 money supply by 50% in the 2 years since COVID started, from March 20 to March 2022, 50% growth in M2 money supply, which is why we got 50% inflation basically over the same time period. So you can't turn your currency into toilet paper and expect good things to happen because it doesn't, right? But we are in an economic malaise. There's, what I'd call an economic soft landing happening. We're cooling inflation. We're destroying demand through higher interest rates, but not crushing demand. We're moderating demand. I don't feel like this is at all like 2008, right? In 2008, it felt like the sky was falling. Um, the stock market decline was worse. The job layoffs were worse. The economic system almost fell over the edge off the precipice into a downward spiral. I don't feel like that's what's happening now at all. But I do feel like it's cooling down. The economy is shrinking, certainly on an inflation adjusted basis, right? The real economy is shrinking, but not dramatically or aggressively. And then there's financing related stress, right? If you own real estate and your interest rates went from 3% to 7%, you obviously have financing related distress, right? For regular people out there, right? They're stretched, right? Their wages didn't go up nearly as much as their rent and food and energy and car prices all went up. So people have been stretched and battered. Um, Now that's sort of my view on where we're at. I do want to say that I think we've beaten inflation, right? I personally think the only thing that's still really increasing in price is labor and wages. And that's a good thing because labor needs to catch up to all of the price increases that have happened elsewhere, right? With my own employees, we give raises in January. I give as much as I can to help, especially our lower paid employees, maintenance workers, property managers, and so on, to catch them up to the cost of living because I care about them. I want them to do well, right? So this labor issue is probably going to stay with us for a little while because there's the annual raise component, and then there's this emotional component of, I want our team members to do well. But that's good because I want those, I want people to have more money to buy food and or to pay rent, and so on. So, I do feel like we've beaten inflation. Labor's the one thing that's really sort of being a bit sticky. It is still hard to hire good people and fill positions, but it's easier than it was a year ago. So the Fed is accomplishing its mission to some degree with these, 12 or so rate hikes that we've had.
That's fantastic. We really moved right along, and we've got a number of questions. So I don't know, the topic was savings versus real estate. I don't know if you kind of want to tie it in a bow and wrap up that portion, and then we'll get into the questions.
Well, there's not a whole lot to tie up, but you should have a plan. You should be saving money. You should be investing. You should have a expert that helps you create your plan and keeps you accountable to your plan. Real estate should be a part of your overall plan. I think a significant part because of the tax savings and appreciation. But obviously it's not a liquid asset class, so you need cash for emergencies. Um, again, don't want to put all your eggs in one basket the way I have. And you know, I mean, yes, real estate's an important part of your overall plan. I think it should be a sizable portion. Really, the tax benefits are outrageously good, and they really add up over time. Um, but yeah, let's move on to questions. Who has
Um,
some?
yeah, I've got them all up here on the screen. The first one is again topical. How is the debt ceiling crisis going to affect what we do, and how is it going to affect the real estate market in general?
Well, I don't know if the debt ceiling is at crisis level yet. If we get to June 1st without a solution, it might get closer to a crisis. Um, it is important, right? I do think the federal government has grown too big. I do think the annual deficit and the total cumulative federal debt are way too big, hugely, hugely out of whack and out of proportion. Um, and this country needs to get a grip on its overall spending and ability to shore up Social Security and Medicaid so that um, today's young people can continue to enjoy those programs. I would, like to see pensions shrunk at the federal level, excess spending, probably less, maybe more efficient spending in the overall defense budget, um, and, more spending in education and more efficient allocation to shoring up some of the entitlement commitments that we've made. But I think this conversation about the debt ceiling is, do you just keep spending and spending until you run the country into the ground?
Mm.
Or do you raise the debt ceiling limit and make some spending concessions along the way to ensure that the United States of America can continue to be um, the best nation to invest in and allocate resources to? Right? I mean, we're still an amazing country. We might be the best house on a bad block, right? China has its investment related and economic related problems and challenges. So does South America, right? So does a lot of places. So we might be the best house on a bad block, but that doesn't mean you don't want to take care of your house, paint it, maintain it, and so on. So we do need to get our house in order, and that's what the debt ceiling issue is about. If we can't solve this in the next 30 days, uh, S&P and Moody's will probably downgrade the U.S. federal government debt, and market interest rates will spike. So it won't be good. I think we will get it solved. Rational heads should prevail.
Agreed. I like the optimism. All right, so here's a good question. We talked about our sponsors or how you pick a good sponsors. I have a question. Can you explain the difference between what you guys offer versus a REIT versus a DST?
Wow. Um, sure. REITs tend to be larger, probably charge more fees, certainly have more corporate overhead, higher expenses, higher fee structure. But REITs tend to be um, usually they tend to take a fund approach, meaning they might buy a bunch of assets. Some assets perform better, other assets perform worse. You put them all into a fund and you get an average return. Um, Avid Realty Partners is not on a fund basis today. We're deal by deal. If you like the deal, you can invest in the deal. If you don't like the deal, kick the can down the road and look at the next deal, or invest elsewhere right now and revisit our future opportunities. Right. I think we also have a reasonably attractive fee structure. Right. We don't take huge fees. We don't take disposition fees. We don't take refinance fees. We take a very modest asset management fee, right? We take a promote structure that only pays us out a promoter carried interest once we hurdle a 7 annualized return to our investors, and we don't have a catch up. So that means, okay, our investors made 7% a year. Now we catch up to 7% a year. Um, we don't do that. We're shoulder to shoulder with our investors on our returns until we hit 7% a year, and then as sponsors we start to take a promote thereafter. So I would say the key differences are deal by deal structure versus a fund structure. And I tend to think of our fee structure as being fairly reasonable, and I'd say those are a few differences. In terms of DST, or Delaware Statutory Trust, it's one of the two ways to 1031 exchange your money. It is gained in popularity and prevalence over the last, call it 5 years. It tends to be a very high fee structure. The sponsors do not take a promoter carried interest. They only get a proportionate share of whatever economics they invest into the deal, but they do get very large fees. So it may not be as performance based as the way we're set up today. But if you have a 1031 exchange, you can either go tenant in common or you can go DST. And there's pluses and minuses to both. But that DST situation is very complex and complicated.
Excellent. For you, what are some of the lessons you learned early on when investing in real estate, in particular multifamily?
Wow. Well, I'm still learning lessons. I'm learning every day, and nobody's perfect. I think it's important to recognize that everyone makes mistakes. I've made some mistakes along the way, and I'm sure I'll continue to make mistakes in the future, but they're going to be different mistakes than I made in the past. Hopefully, I don't repeat mistakes. But what are some of the lessons learned? I mean, the biggest, hardest, toughest lesson of all is to not overpay for your assets. A lot of people overpaid for assets in 21 and 22, right? We sold a few assets at the peak. We bought one asset at the peak. Um, Even buying one at yesterday prices doesn't feel good. I feel like we were fairly disciplined overall, but even one can be painful. And what I what I think is a lesson, right? A lesson learned, right? Sort of associated and related to that is everything is a cycle. The economy is always a cycle. If we have a boom, at some point we're going to have a downturn. Um, I tend to look at things on a peak to peak basis, or on a trough to trough basis, or peak to trough, or trough to peak, right? How long have these historical economic cycles been from peak to trough or trough to peak? And how does this cycle stack up against history? There's a lot of folks on Wall Street, economists and so on, that that look at that type of data, and I'm in that group of folks to look at that data also. But you have to remember that everything's a cycle, um, and act accordingly. Personally, I think this is a great buying opportunity and a less great selling opportunity. Um, Down the road, it could be a great selling opportunity and a less great buying opportunity. But that's another lesson. And then look, just in terms of the assets that we're buying, we want to buy quality assets with residents that earn stable income and can afford to pay rent and care about their credit so that they pay rent. And when you're just starting out in the business, you don't necessarily have entree to those assets in scale and in size. You might be able to buy two families or four families in great locations, but not 200 unit deals in great locations. You have to sort of earn your way up there. But like, I think, this economic malaise is forcing everyone to buy assets where their customers can afford to pay rent and care about their credit so that collections are high. Those would be, a few things that come to mind. I guess just a couple other things, right? A couple other lessons. Extreme property level execution is necessary to delivering returns. I don't believe in just buying low and hoping the market goes up and selling high and doing nothing to take care of the asset or improve the asset or to take care of operations. So extreme and highly engaged property level execution, absolutely critical. Um, and then I sort of touched on this, but lessons learned. You have to treat people well. You have to be a nice person. Have to I think it's important to be kind to everybody from our porter and maintenance guys up through our property management, including our residents, um, our investors, and so on. I think, and that includes being good to your communities, good to the communities that your properties are located, interfacing with the police department in those locations, interfacing with other community leaders or people in the government. So those are some lessons learned, I guess. Wow, that was a lot.
Not at all. And I swear this is in the queue. I'll take a shot and send it to everyone. It says, "How do I invest with Avid Realty Partners?" That didn't come from me.
Wow, somebody teed up a super softball for me. Um, yeah, look, reach out to Jim or to myself. Send us an email, Craig at avidrealtypartners.com. Go to our website. You can click the Invest with Us button, fill out your information. Typically we start at $50,000 minimums, right? Once you're in the deal, you're in the deal. There is no get rich quick. In real estate or in life, if anyone tells you otherwise, run the other direction. But we do think we can generate wealth and strong returns slowly over time. And I do think that now is a phenomenal time to be putting capital to work, right? Frankly, I think the stock market's going to have a good year ahead also because the Fed has basically said they're done raising, more or less. Um, and historically, the stock market rallies after that is sort of publicly stated. Stock market's already starting to rally a bit, has rallied some, could rally more, right? But I do think tax efficiency of real estate and the ability to choose sponsors that are aligned with your interests and your view on the world is, some of the things that make real estate a phenomenal asset class. This is a great time to be putting money to work while so many people are fearful. Time to be greedy when others are fearful. There's a lot of fear out there, and understandably so.
Um, this I was going to say that's the last question. It'd be great to end on it, which by the way, I didn't send that. Um, but someone did say you had mentioned that now is a great time and that sitting on the sideline is says foolish. But with interest rates where they are, how are you able to find deals? And I think, it's an interesting question, but it's what we're doing all day long. So I think it's probably good to address.
Well, we have three people on the team members that I love, adore, and can't live without that do spend all day searching for deals, following up on deals we underwrote 3 months ago, 6 months ago, a year ago, hanging around the hoop, on the phone or emailing with all the brokers in the markets that we like. So it's not a casual process, but regarding interest rates, I mean, interest rates are high, um, but asset prices have come down. So I tend to think of interest rates as being temporary, and your cost basis in the asset as being permanent, right? I do expect interest rates to come down. I think we're going to be borrowing for multifamily properties in the 4 to 4.25% range again, probably within 12 months, from Fannie and Freddie. So, if you find an asset that you love or a deal from a sponsor that you love, I would say, if you can get it for a reasonable price or a price that's come down versus where it was a year and a half ago, then go for it. Because I do think interest rates are going to fall. I have a whole bunch of reasons why I think that's the case. Um, but again, interest rate is temporary and your cost basis is forever. So I'd say if you find something you really love, go for it. If you want to know why I think interest rates are falling down or are going to fall and are coming down, I'll tell you. And that's there was 8 or 10 years from 2010 to 2019 where the 10-year Treasury rate was sort of between this 2 to 2.5% range, and now it's closer to 3.5%. So with 3.5% Treasury rates, I'm borrowing from Fannie at 5.25. To the extent that comes, the 10-year Treasury comes down a point, I think I'm borrowing from Fannie at 4 or 4.25. And frankly, I think our deals are going to exit at 4.25, 4.5 cap rates. I think multifamily cap rates are generally more or less going to be at your cost of Fannie or Freddie debt, right? There is no positive spread day one. You have to earn your positive spread over time through execution and growing rents. But we're not underwriting to a 425 or 450 exit cap. We're generally underwriting to a 5 or 525 type of exit cap. But as the 10-year comes down, as it becomes more clear that we've beat inflation, as the Fed wipes egg off its face and begins to bring the federal funds rate down, um, you know, the Fannie Freddie debt rates will come down, the bank debt rates will come down, the cost to borrow for hotel properties will come down, and the world will start humming again as all those folks that are on the beach come back into the market. So I'm trying to buy the best quality assets I can and hold my nose for the next 12 or 18 months on interest rates. Um, if we're taking a 5-year fix from Fannie, I might have to hold my nose for the next 5 years on a deal, but still borrowing at 5% with the rate buy down, it's not terrible. I can live with that for 5 years. So, that's sort of our view on treasury, where it's going, where it's been, where it's going, how that relates to your cost of borrowing. And really, if you find a quality asset that you love at a fair price, at a reasonable price, and in a great location, don't worry about the interest rate as much. Obviously, you have to run the numbers, you have to be careful, but um, it's probably going to be more expensive tomorrow when rates come down.
I think that's a great place to hit pause. I mean, as promised, we covered interest rates, the debt ceiling, our philosophy, savings accounts as advertised, your Spirit airline, frequent flyer miles. I think we covered it all. I will say the questions are flooding in. So I'm glad it was so interactive. I hope everyone saw value in this, and it certainly was a pleasure to do. But I'm glad everyone saw value. With that, I'll let you wrap it up, and we're as delivered.
Everyone, thanks so much for joining. Reach out to me, Craig at avidrealtypartners.com. You can reach out to J. McCarthy at avidrealtypartners.com. Really appreciate you joining. We always have deals and opportunities at hand, and we'll catch you on this one or one in the future soon. Thank you so much. Bye.